All right, so on to part two of leisure service financial management. The private nonprofit sector. They're private in the sense that they are not owned or directed by the government. Nonprofit in a sense that they must generate income to at least cover their own expenses, yet they do not generate profits for the purpose of making anybody more money. So if they have additional revenue to put back into the company, not into any investor or owner's pockets, so to speak. Nonprofits exist to meet the service needs of selected consumers, so it's not a community-wide effort, but a little more specific than that. When a public sector is either unwilling or unable to function in this capacity to fulfill the need. It's also where commercial organizations are also unwilling or unable to conduct business. So the commercial enterprises, we're looking at for profit, so maybe in areas where there's no profit motivation and the public may not be able to serve specific needs. A real good example of this is the Boys and Girls Clubs of America. So they operate in areas for services and facilities that may not be commercially viable for profit, and also offer services and facilities that maybe the government can't specifically work on for a variety of different reasons. When we look at legal and legislative parameters, nonprofits operate under a different set of laws. So most of them enjoy a tax-free status, so they're not paying taxes on certain things. And donations by individuals and corporations are usually tax deductible by those individuals or corporations as well. So for example, if a nonprofit gets a grant from a foundation or a corporation, let's just say Kroger donates to the Boys and Girls Club, that donation is tax deductible for Kroger in some capacity. Nonprofits need to be registered with the Internal Revenue Service to get that tax status. There are a variety of different ones, but the most common one is a 501c3 status, and this is a nonprofit status through the IRS. They must be registered with the state where they're located, so this is usually with the Secretary of State at the state level. These nonprofits exist in a world where they have social roles and social expectations. So they exist to meet social needs. Some are more selective, so they focus on a single or a narrow cause, and some are more broad. So a good example would be like the Boys and Girls Club helping at-risk youth, other ones helping develop coaching skills, or some even having a family focus for development in the family unit. When we look at the market management techniques for the nonprofit sector, we need to realize that there's a relatively narrow focus that restricts its market. This dictates the techniques used to effectively and appropriately manage the consumption process. So, pricing decisions are at least break even. A lot of times they're a recovery more than break even. They're looking for donations and other things to help offset their costs. Service allocation is based primarily on need, not so much where the money flow is. The indicators of success for the nonprofit sector is primarily by comparing their achievements to their goals. Having very specific goals and seeing how they measure or evaluate to achieve those goals. It's important to remember that their goals are not tied to financial success. The focus is on achieving social benefits and generating enough revenue just to stay operational, not necessarily to make a profit or anything like that. The financial management opportunities and challenges are very different for the private nonprofit sector. Public sympathy and affection are two important advantages in fundraising, looking at specific causes or just a heart for the specific organization. There are tax breaks and discounts that allow organizations to extend their financial resources. So if we look at tax breaks, for example, they can spend more money without having to incur a lot of sales tax related to the nonprofit organization. When we look at challenges, small nonprofits may not have a fundraising staff. So the small nonprofit may have a director and a program manager, but not anybody specifically tied to fundraising. So it falls on the shoulders of those other individuals. The extension of credit by vendors is dependent upon perceived ability to pay. So if you have a larger or more historically situated nonprofit, vendors are more likely to allow credit when purchasing products or services or whatnot. And then we're going to look at protecting the financial resources for the long term. Again, this is a challenge as we are not specifically pricing services and operations for profit for the long term. Then we'll look at the organizational structure of the nonprofit. In general, a nonprofit has a board of directors. That board of directors oversees the total management of the organization and often does so through a director of the organization. So the director is a usually full-time, or at least a part-time staff member that carries out the day-to-day operations. From there, under the director, you have various full-time, part-time, and volunteer staff that carries out the functions in the day-to-day operations. In the nonprofit, financial objectives are linked to a stated purpose, and their goal is to generate revenue to pay for their obligations, so cost recovery. The Internal Revenue Service places restrictions on some uses of funds, depending on how the funds are attained. The nonprofit has various financial objectives, mostly related to cost recovery. A majority of them do not have capital investment projects, and so forth. Many have unique cash flow circumstances. A good example of this is Boy Scouts. Boy Scouts generate 85% of their income in 3 months through certain activities. However, they have year-round expenses and they need to make sure that they're properly managing their cash flow. For the nonprofit, they are frequently dependent on the goodwill of members and donors. So they frequently cannot generate sufficient revenues from those they serve as far as fees and charges. So they look for donations, grants, and so forth. If we look at account management, we have to consider the different sources of income. These include fees for programs, special events. We have different donations and bequests, government grants and contracts, private grants, and things like the United Way. Oftentimes, their financial solvency ranges from month to month with their different financial issues related to the nonprofit. Sometimes budgets can be very minimal, and sometimes it can be into the millions of dollars. So it's important to know that different nonprofits operate at a very different level. Financial operations and debt management principles are consistent throughout the organization. This is very important. And remember that they operate mostly on a month-to-month basis. Now let's think about reporting related to financial management. There are different options including monthly, quarterly, and annual reporting. They may use multiple standard reporting formats for different purposes. In minimal, there should be at least a monthly accountability related to their financial status. Most of the time, external funding requires a standardized account and reporting process. This is for state and federal government grants and some, or I should say most, private grants as well. When we consider performance evaluation, we are also looking at a commonly required annual report. United Way, for example, can require very specific reporting and accountability for their funds for nonprofits. Larger organizations have annual reports, but sometimes smaller organizations will do quarterly as well. Again, when we think about performance evaluation, we need to make sure that we understand the common measure is a percent of operating budget spent on administration. The less expended on administration allows more funds to be spent on the mission. Let's look at a little comparison here of the public and nonprofits. So different examples include state park systems, county park systems, and community parks for the public sector. Organizations in a nonprofit include such things as the YMCA, Boys and Girls Clubs, scouting organizations, conservation organizations, and so forth. For the public, our source of revenue is primarily taxes, such as property tax, dedicated taxes, and so forth. For nonprofits, our sources of revenue includes grants, membership fees, fundraising, donors, and other things like that. In our public organizations, we look at financial measures of success being fees and charges generated and financial accountability. Our financial measure of success with a nonprofit is achievement of our goals and objectives and outcomes, with financial aspects being secondary. That concludes part 2 of Leisure Service Financial Management.